Afternoon, and thank you for zooming in to the April 9th installment of our BHS Masters Today series. This afternoon, we're pleased to shelter in place separately and safely apart from Stephen Lascher, sales manager at Wells Fargo Home Mortgage. Stephen, welcome. You're bunkering in place from an undisclosed location, so in the interest of the safety of you and your family, I'm not going to disclose where that is. But as we begin today's webinar, let's cover just some mortgage basics, a little summary of mortgage basics, some of the terminology, conforming or agency loans, non-conforming jumbo loans, limits. Why don't you just take us through that briefly before we get into some of the stuff that applies to today, just to get people's minds on the mortgage market.
Sure, sounds good. Well, good afternoon, everyone. First off, I just want to, wish you all well. I hope that you and your families are safe and well as we navigate through this extremely difficult time. I am sure we will figure out a way to get through this together and hopefully be stronger than ever before. To Neil's question, I think we were talking about maybe some of the mortgage basics, really being able to separate the two different types of loans that exist in the market today. One being what we call agency loans. Another word or synonymous term would be conforming loans. And those are loans that we as lenders sell to, let's say, the government, quasi-government entities, which are better known as Fannie Mae and Freddie Mac. The other side of the house, the other loans are what we call jumbo loans, or loans that we hold on our balance sheet, and which we're not selling to Fannie. To give you an idea, I would say ballpark nationally, 75% of the loans that Wells Fargo originates are sold to, these quasi-government entities, Fannie and Freddie Mac. The other 25% ballpark are loans that we own and we hold on our balance sheet. Interestingly enough, those of us who sit in the New York market, I would say it's the inverse for the New York Mortgage Origination Group here, where 75% of the loans that we're originating in our local market are typically held on balance sheet. One of the reasons why, one of the things that define an agency or a conforming loan are the loan sizes. So the national Fannie Mae conforming loan limit today would be for any loan under $510,400. There's a second segment or tranche, let's say, of Fannie Mae loans that was rolled after the credit crisis of 2008-2009 for high-cost areas like Manhattan. And that loan limit today is $765,500. So essentially anything under $765,500 are loans that we would be selling to Fannie and Freddie. Anything over are loans that we would be holding on our balance sheet.
And go ahead, I'm sorry.
Just one additional thing I would point out would be that, one of the reasons we would hold something on balance sheet in our market versus selling it to Fannie Mae outside of the actual loan size would be if a buyer is looking to vest in some sort of LLC or a trust. Fannie and Freddie do not allow that. That's something that we would accommodate. In our market, where we deal with a lot of what we call non-warrantable condos, where you have limited pre-sale or other complexities that may not fit the Fannie Mae criteria, that is also a scenario where we would hold a loan on balance sheet.
And that loan you mentioned, 765 and change, how often does that loan limit change?
Sure. So it's reviewed annually. So, over the course of the last 10 years, we've seen that number increase incrementally every year.
Okay.
That's not a guarantee, but depending on property values and the need, to provide liquidity into the markets. One thing I would I'd back up and say,
sure.
One of the reasons that Fannie and Freddie Mac exist is, they were designed to help provide liquidity into the residential real estate market and to help support that market, nationally for the U.S. And so it's one of the reasons, candidly, that they exist.
Okay. And you and I were talking earlier this week, and we talked about the idea that the loan rates were a little bit lower in the past for some of these conforming loans or these agency loans, and people put more money down. They increased their down payment so that they could benefit from the lower rates of the smaller size loans. Is that what you would advise people to do now, increase down payments? Or how has that relationship changed over the last 7, 8, 10 years?
Sure. Yes, to your point, Neil, historically, many buyers would look to put, or borrowers, excuse me, would look to put down additional funds so that they could fall within the Fannie Mae loan limits, because those interest rates were really being subsidized by the federal government. And so by falling into that category, historically, you were obtaining a lower interest rate.
Mm-hmm.
There's been a shift in the markets, candidly, since the credit crisis, when these entities essentially were bankrupt and needed to be bailed out by taxpayers. And so as such, and since, they've been mandated that they do need to be profitable and be more cognizant of the rates that they're offering. And because interest rates have dropped so much, or the cost for banks to borrow themselves, interestingly enough, many times loans that we hold on balance sheet or jumbo loans today actually have lower rates than some of the Fannie Mae products. It really depends. It's case by case.
Okay. Can you make some distinctions? Because I hear, again, terminology-wise, I hear people refer to lenders as mortgage brokers, brokers as mortgage lenders. You, I think, were able to settle some confusion with an email you sent a few days ago about a correspondent desk. I've heard the term wholesale departments. Can you tell us a little bit about, or distinguish between a direct lender, a mortgage broker, your wholesale or correspondent department or desk, and the advantages and disadvantages maybe of a few of those, and who's still in business today?
Sure. No, I think great question. I think there's really three main categories that I think we can tranche into. One would be a direct-to-consumer lender, like, let's say, Wells Fargo, JP Morgan, Bank of America, Citibank, the four big banks, right? If you and your clients refer a client to us, we are directly providing a mortgage to them, bank to consumer, and we're only offering our bank's product, right? The second option or second tranche would be, let's say, a mortgage broker. After the credit crisis of 08-09, mortgage brokers became less prevalent. They really did have a strong place in the market, but it was hard for many of them to survive because we as banks were no longer accepting loans through third-party brokers or wholesalers, as you mentioned, to bring loans into our system that we would want to purchase and own. And one of the reasons,
in a sense, they were acting as a sales force for your loans and other banks' loans.
Correct. They were acting as a third-party intermediary, somewhat like a real estate broker would, to connect, right, a seller to a buyer, connect a borrower to the bank, and they would facilitate that, and we would then take on that loan. But there are fewer mechanisms in place for us to protect against fraud and credit risk by having a third party facilitate that. And so I believe all four of us exited that business. The business does still exist. A mortgage broker in Manhattan that many of you probably know, and one of the few that exist, is Guard Hill Financial, right? I would say they're probably most appropriate, and I don't want to speak for them. I don't know all of their product, but maybe for a foreign national buyer or someone who does not have an ability to document income, they may have a little bit more flexibility as a broker in those areas and where they would bring value.
Okay.
The third would be what's called a correspondent lender. And that's where I sent an email and wanted to create some clarity. I think there was some concern that Wells Fargo may have pulled out of lending in the balance sheet or jumbo space, as we call it, or non-conforming. So non-conforming, jumbo, balance sheet, all the same thing, i.e. non-agency type of loans.
Okay.
That's not accurate. What is accurate is that we stopped purchasing loans through our correspondent lending channel. And a correspondent lender, as example for the audience here, would be, let's say, a guaranteed rate, right? So guaranteed rate would actually fund the loan in their name. So they have credit lines, warehouse lines with their own financial institutions. They would fund a loan, but they would fund that loan and they would immediately sell that loan to Wells Fargo. So their process of underwriting and processing, they were following the guidelines that Wells Fargo set forth with the understanding that we would purchase the loan.
Okay.
At the moment, we are no longer taking those loans into our pipeline, really just so that we can protect our balance sheet and candidly make sure that we're allocating those dollars and resources during a difficult time toward, our direct-to-consumer clients.
Okay. So wealthy people with a lot of money can still get loans at Wells Fargo right now, is what I'm hearing.
Without a doubt. And, many people, whether it's an agency loan for a purchase transaction or a balance sheet loan for a purchase transaction, we are open for business. We are lending. And candidly, we are very focused on ensuring that we are supporting not only the U.S. housing market, but our core business partners, our real estate developers, attorneys, and developers during this difficult time.
So let's quickly shift gears. I know people tuned in for information about what's happening during the pandemic, what's happening specifically with respect to lending and the process and procedures. So terms that we hear, they were covered to some extent on Tuesday in another webinar. They're down in Baltimore and Chicago, but apparently drive-bys are up here in New York, and we're talking about appraisals, Stephen, okay? Desk appraisals, exterior appraisals, interior appraisals. Can you walk us through some of those terms and what the implications are, how they differ, what impact they'll have on really borrowers and their ability to borrow money to purchase, especially when we come out of this lockdown or pause period, if you will?
Sure. So I think, as we all know, the appraisal process is a key component to what we do, especially as lenders, because that's the collateral that we're taking to lend against. Unfortunately, with current circumstances, being very cognizant of the health and safety of both the real estate brokers, the buyers, the sellers, the appraisers that we have on staff, Wells Fargo has made a determination that we will not do any interior appraisal inspections, with the exclusion that we will do an interior inspection if it is a new development property that has not yet been occupied.
Okay.
Now, as an alternative to that, I think we've come up with a very appropriate solution, as many lenders have, and that is that we will accept exterior appraisals on everything else, essentially. An exterior appraisal is simply that the appraiser does not need to gain interior access to the unit. They will use your listing photos to complete the appraisal. Now, that said, when there is an exterior appraisal that has been completed, there are some limitations to, or let's say pullbacks to, our credit policy versus what would be offered if we were able to complete an interior inspection and really fully evaluate the collateral. And I can highlight, what those pullbacks are. I have to say, on purchase transactions, the pullbacks are minimal. So again, Wells Fargo is very focused on ensuring that we are supporting our core purchase partners. So the pullback on purchase transactions for, most of the brokers on this call, we were financing up to 90% or 89.9%. At the moment, if there's an exterior appraisal that's been completed, we will max at 80% financing.
Okay.
So not a massive impact it will have on some of the lower level transactions, but we're still financing 80% to $3 million in loan amount, both with amortization and interest only, with an exterior appraisal, assuming the borrower qualifies. The second limitation we're seeing is on multifamily property. So we did always finance to 80% on two-family properties in the New York County and Kings County markets.
And is that high by industry standards, 80%? We talked again offline, and I've always heard 65, sometimes 70, but two-family, three-family, four-family, how are they looked at? We do have, multifamily investors that work with our agents.
Yeah, no, great question. I think that historically our standard guideline on a two-family was actually 70% and then 65% on a three-family, because of the incremental risk associated with might be an investment property.
Okay.
That said, to your point, we have been, I'd say quite aggressive in the two-family space over the last few years, and specific to Kings County and New York County, where there are so many two-family homes that are really occupied as single-family homes.
Right.
We were underwriting and allowing borrowers to leverage up to 80% on a two-family as if it were a single family, as long as they did not need the rental income on the second unit to qualify.
Okay. They qualify with their own profile, independent of the additional rent income that might or might not be generated by the second unit.
Correct. And really, those are the two main drawbacks when it comes to purchase. The only other thing that I would say is when you're doing an exterior appraisal, there is a limited appetite to make exceptions that would go beyond our standard credit policy at the moment.
Okay.
What I would say is these are all very fluid. I mean, we have never seen change occur, from an industry perspective as quickly as we're seeing changes today.
Right.
And, the banks are doing their best, all of us, to try to provide as much liquidity into the markets as we can.
Right.
So what I would say is that, so while those are the only two major pullbacks, let's say a month or two ago, if someone were buying a $10 million apartment, let's say, and they were normally looking to borrow 60% or our guideline allowed 60%, we may have, been willing to go to 65 or 70% leverage for a well-qualified borrower.
Okay.
The appetite to make those kinds of exceptions will be limited, at least in the short term.
Okay, that's fair, I think. I mean, we want to keep the financial system on healthy footing as well. So I have two questions along this thread.
Sure.
How many people, I think it begs the question, how many people were actually applying for 90% financing, up to a month ago, where they're potentially impacted by the limitation to 80% or 89.9 to 90? I mean, to 80. Is that going to have a significant impact on the market in general? I mean, what percentage of people were still borrowing 90%?
I think it was a fairly limited number in our market, right?
Okay.
So it'd be hard for me to speak nationally just because I don't really have that data.
Right.
Listen, I think it's something that's nice to have. It helps drive, acquisitions in those lower price points. And candidly, they're not really lower price points. I mean, the fact is we were financing 89.9% to $1,250,000 in loan amount. But it seems that there seems to be, maybe not in the last few weeks, but still significant demand kind of up to that 2 million price point in the market, or there had been.
Right.
So I think sellers, quite candidly, were likely had more optionality to take a buyer who wasn't looking to finance 90%. So I think the impact will be minimal.
Okay. And I don't know how much you can discuss of this publicly or really give us any specifics, but to the extent that you can, since today's April 9th, so let's say April 1st, the last 8 or 9 days, have you on the desk observed any real variance between contract prices and appraised values that come back in these appraisal reports?
I think another great question, quite candidly, not yet. So I think the question was, have we seen appraisal values come in low compared to contract price?
Right.
At the moment, there have only been a few, right? Because it's such a short window of time. But appraisers are typically using closed comps that have occurred within the last 6 months. And that's what would be in their report, along with maybe 1 or 2 recent listings with a discount based on current market. I haven't seen anything come in low yet. Maybe there have been a dozen so far that have actually happened, and they have not come in low. There was one actually that it took place yesterday that I'm still trying to ascertain how we'll manage it, where the appraiser did indicate concern for a declining market to take place, right? Based on CV19 and our inability to really fully comprehend what the impact of that will be today. I wish I had a clear answer on that at the moment. By next week, we should know how we're actually going to manage it. My gut is that we're still going to move forward with the transaction, though there might be a situation where maybe there would be a slight pullback to loan to value. If we were at 80, maybe we'd want to be at 75 or something like that, just for full transparency. We're not there yet, but we should know shortly. Okay.
I think that's encouraging, actually, at least at this point. But as you said, this is dynamic, and we are going to be changing by the hour, it seems, in some cases. We talked about the appraisal situation, the process, the changes, the adaptations, and this is the other important topic among a few others that we'll touch on, but really pressing is the idea of virtual closings. Again, there was a treatment of this on Tuesday in a webinar, and my understanding, and you can certainly correct me, was that there was some concern for banks, not just about contamination or getting too close to people and physically being in the same room with 3 or 4 different parties to the closing, but the inability for the New York County clerk, which was closed for business as non-essential, to record transfers, deed transfers, and liens. So how are they handling that? How are they mitigating that risk? And how much of a concern is that to banks, if it was at all, or if I was hearing, just rumor?
No, what you heard was very real. I think that there was, one, it's just know that the virtual closings in general are still a work in progress. There are significant concerns about fraud that could take place, multiple loans that could actually close. If a borrower were to close on a transaction, we hadn't recorded our lien and then close on another loan, and now 2 lenders may have funded on the same transaction. So there are some concerns about the virtual process, which I know wasn't exactly your question, but
Well, they're tied together, so we're going to treat both of them. We're going to address both of them. So, in whatever order is comfortable for you.
Great, thanks. In terms of your point regarding ability to record, it is a real concern because we are able to actually get to the closing table, but if we can't record our lien, we have an issue. So most title companies, most of the large title insurers have what is called gap coverage. We as a lender are requiring that any title insurer that's being used on any of our transactions, and again, almost all of the major insurers do have this, have gap coverage. What it is it covers the lender during the gap of time in which the closing takes place and the lien has been able to be recorded. So while the city county clerk's office is closed physically, they are accepting electronic recordation, and we are working through it. But it's not something that's as immediate as the title company historically being able to record by end of business, right, or by next morning. Now it may take a few days, but as long as that gap coverage exists, we're fine.
And who's typically on the hook for the gap coverage? I'm guessing, if I know insurance companies, they're raising the premium on gap coverage, in this crisis, because as you said, those periods have extended between closing and the ability to record. So who's bearing the brunt of those cost increases?
This is still new to me, but my understanding of it is that this is a coverage that these insurers really had in place anyway. And it's not an additional policy that's being passed on, let's say, to the buyer or the lender. It's something that I'm going to make a note of to make sure that I follow up and confirm, but that is my understanding.
Okay. And what logistics, I think, as you said, there are a lot of differences. No 2 closings, it seems we could say, are going to be alike in terms of logistics. So for the sake of entertainment, can you give us an example of a recent Wells Fargo closing and how the logistics specifically were handled?
Sure. I mean, I think it really, and I'm going to keep our focus. I've been trying to keep the focus of this on purchase, right? There are finance scenarios and, that we can get into, but logistically from a purchase transaction, if it's a single family home, townhouse, or condo, assuming we're not doing a virtual closing, really what we've seen take place is that really the buyers have provided power of attorney to their attorney, sellers have provided power of attorney to their counsel, and then those 2 parties have met in a location that they feel is safe and likely sat in different offices and signed the documents on behalf of each side of the transaction, transferred those documents to each other, countersigned, and then candidly moved on and been able to complete and commence the closing. It's become a little bit more difficult in a scenario where you either have a sponsor sale involved or a managing agent on a co-op where the stock certificate and the lease needs to be, provided. So as long as that managing agent has a certain comfort level with the small physical component of the transaction, it can be facilitated. We have some that have been very quick to accommodate. We have others who have made it very clear that they feel that the executive order from the state, from Cuomo's office is that they're not essential, let's say, and that they should not be completing the transactions in a physical nature. Now, that said, virtual closings are imminent, right? Where these can be done through Skype or Zoom. Well, there's actually a system which is called RON. I think it's residential. RON, RON. I believe it's Residential Online Network, and I could be inaccurate there. Again, if I don't know something 100%, I'll caveat it.
That's fine, Ron. And is this new? This Ron? Is this a product of the pandemic, so to speak, or is this something that's been people have been toying with in the past?
I think it's a system that has existed, but it's now only being utilized and leveraged because of the ability to use a virtual notary, right? So I had never heard of it before this. Really, what it'll allow us to do is to close loans completely virtual, right? Due to the Cuomo ability to have a virtual notary, the RON system allows certain ways to identify and verify who the parties are, that they are in the location that they specified that they're in, that they are the parties that they believe they are. At the moment, Wells Fargo has not officially rolled out virtual notary, virtual closing. What I can tell you is internally, it has been fully signed off on and approved from a legal and compliance perspective. Our goal is that as of Monday, the 13th, I believe is the date, what we will officially roll this. And it's really just been that we're working through the logistics of it, and who, which title companies and bank attorneys will allow to close via this process and have the appropriate systems, and which don't. So it is coming, and it's coming in the next week.
Did your compliance and legal people sign off in separate rooms or through Ron on the policy?
I have a feeling there were a lot of virtual calls, lots and lots of virtual calls. In fact, interestingly enough, one of the challenges I think we're all facing is, we need to, applaud our technology teams who are in the background, because Wells Fargo has 280,000 employees. Over 150,000 of us have, converted to remote work, and they've done an amazing job of getting us set up and able to transact.
And certainly the same could be said for maybe on a smaller scale for the folks at Brown Harris Stevens. Jeremy Kersner, as you've been introduced to, has been terrific on these setups for us as well. So thank you to him specifically, and to all the tech people, really. Well, okay, so virtual closings. Let's talk about rates and products right now. Let's go back to some mortgage basics, because there are terms that fly around in the press, and these are things that we need to be able to discuss, we'll understand, so that we can discuss them and make a difference when we're having a conversation with people. There's an independent relationship between mortgage rates and the Fed funds rates, but every time somebody hears that the Fed is reducing rates, or on a Sunday they reduce rates instead of waiting for the next meeting on a Wednesday, they take them down by 25 basis points. What does that mean for the people who call Stephen Lascher and want to borrow money to buy a home?
Sure. Funny enough, it's made it very challenging recently, because, while the media is indicating that, rates have dropped, they're going to zero, and to a certain extent that's accurate, but we're talking about the Fed funds rate. And the Fed funds rate is really a short-term interest rate instrument, right? It is what it's the federal government's overnight lending rate to banks, right? And where I think that there's a discorrelation, or where there's confusion, is those are short-term rates that we borrow at. Mortgages are really long-term mortgage products. And so just because the short-term rate has come down doesn't necessarily indicate that there's a direct correlation to a mortgage rate coming down at the moment. I also think that, to elaborate a little more, markets have been so extremely volatile. I mean, we've had at least a decent week in the Dow, and there's been less volatility. But over the course of the last 2 or 3 weeks, we've seen 1,000, 2,000 point swings in the Dow. Treasury yields have dropped, over 1% in such small increments of time, that for lenders to kind of evaluate that risk and just drop immediately creates too much too much credit exposure and concern to not be cognizant of the volatility and not necessarily drop a direct correlation.
What is that relationship between mortgage rates and the 10-year Treasury? You mentioned Treasuries dropping, and that's something we've heard historically. Is there still a relationship? What's that relationship based on? Can you tell us a little bit about why we should pay attention to that 10-year Treasury?
I do think that the 10-year Treasury was really a benchmark for consumers to evaluate, the pattern of, as 10-year Treasury yields went down or Treasury interest rates went down, mortgage rates would typically follow suit in quite close correlation.
Okay.
And what I would say is, just to give a little bit more background, when investors get nervous and they sell stocks, they sell securities, they sell out of the Dow, and the Dow is going down, what they typically do is they retreat into a safety area and they start buying up, government-backed bonds or U.S. Treasuries. And as you buy those bonds, and there's this quick, shift from equities to bonds, you drive, demand is there, you drive up bond prices. So the more you pay for a bond, then the lower the yield is and the lower the interest rate is. I.e., if a bond has a value of $100 and an interest rate of 5%, your yield on that is, right, $5. But if there's so much demand for that bond that you're now paying $105 for a bond that only has a value of $100 with the same note rate of 5%, your yield is now less than 5%, let's say 3 or 3.5%. That is basically the 10-year Treasury yield going down and how that happens. It does correlate to mortgages, but as I mentioned, with the volatility in the market, there is a discorrelation. And I think part of that is that, at the moment, lenders are having capacity issues in terms of our ability to manage the massive amount of volume and inquiry that is coming at us for refinance transactions. And so I think, correct, for refinance transactions. And so because the bank is cognizant of providing a seamless and positive experience for a consumer, one, and two, making sure that, again, we keep that dedicated lane, that priority lane for purchase transactions to not only help support you, but support the real estate, market in itself.
Right.
So I believe that one of the reasons rates have not dropped in correlation with 10 years to really just slow down some of that refinance volume to ensure that we're providing the level of service that we need to.
And that's systems, that's tech, accounting, that's labor, that's bodies, that's computers that can ingest the information that's coming in, processors, across the board.
And I think across the board. And then I think even more recently this week, interestingly enough, candidly, the need to allocate some of those dollars to other areas of the bank, right? So, at the moment, there's a $400 billion stimulus from the federal government to help support small businesses, right? And so, while it's very important that we continue to support the real estate market on purchase and we want to help refinance consumers, the bank is allocating a lot of dollars now to fund these small business loans very quickly to help with the larger economy. And candidly, some of those resources, those processors, those underwriters, instead of having them focus on refinance transactions, have been reallocated to support some of the small business and the federal stimulus.
Okay. Well, that makes sense. Some these businesses are struggling, so it makes sense, and it's great to see that corporate America, often maligned, is doing its part to, especially the banks, is doing its part to service the people, that are the backbone of the economy, really.
For sure. And to even dovetail on that, I think another area that some of those resources are being allocated to is to our servicing teams, the people who are picking up the 800 number for our mortgage borrowers. In the last 3 weeks, my understanding is that over 500,000 Wells Fargo mortgage holders have reached out to us and asked that we defer their loan payment for 90 days. And my understanding is that we have accommodated a very, very, very large percentage of those those borrowers to try and help support the market. So not only have some of the human interaction been allocated there in terms of resources, but candidly, the deferment of those payments equates to, well over $1 billion in deferment of mortgage receivables.
Well over $1 billion?
$1 billion, correct, across
Okay.
those $500,000 mortgage holders who have asked us to defer those payments. Those payments in dollar amounts exceed over $1 billion that we are deferring at the moment, and candidly carrying that expense.
And is there a standard? This is the forbearance practice that we're hearing about so much. Is there a standard? If I call and I get somebody on that 800 number, do I ask for a month, or are you looking at it case by case? Some people need 3 months, some people 6. How are you making determinations? Is there anything you can share with us?
Sure. My understanding is that it's case by case.
Okay.
Though I believe that we've been quite liberal with the ability to accommodate. That said, I would caution people who really are not facing an immediate financial hardship from asking for that deferment of payment. The fact is, my understanding is that we're not reporting a borrower delinquent or late on their mortgage payment for requesting the deferment if we've agreed to it. But we do report that there was a deferment of payment. And, because we've never experienced something like this, we're not sure how another lender may actually view that if and when someone's applying for a mortgage or any other type of credit with that bank, down the road.
Right.
I would say internally, I was having a discussion with someone the other day about this, and the question came up, if we financed a purchase transaction for a borrower and within the last year we were able to validate that they had $1 million in the bank, right? And now 6 to 9 months later, they've requested a deferment of payment from us. And now 6 months or 9 months later, they come back to refinance or they come back to purchase. And we see that they really had the financial wherewithal to make those payments. I think that it does pose a character concern, right? And I think that could impact someone's ability to obtain financing down the road in the event that they really were not under a hardship and took advantage of it. So again, that's not a blanket statement on behalf of Wells Fargo, but my interpretation of what I'm seeing.
Yep. So let's look at a specific scenario. I was a shopper, and this relates to much of what you said. Maybe you can give us a few more specifics. Average price of a Manhattan apartment, $2 million, give or take. I was getting a bonus. I was gainfully employed, and so I was shopping in early January, and maybe on the 15th or so, I applied for a mortgage, and I had certain requirements to meet based on the criteria that were modeled for Wells Fargo's clients. Well, the same guy comes in and say, the city's open for business, New York State, the mandate is resume from pause. I go out shopping, I see 10 or 15 apartments, May 15th, I apply. I call Stephen Lascher and I apply for a mortgage on a $2 million apartment. What are you going to tell me as far as my profile and my profile requirements and collateral requirements for that matter at that point that are different from what you would have told me in January?
Sure. So I think that it is such a fluid environment. I have never seen such rapid shifts and change. I mean, even during, the credit crisis a decade ago, there weren't, immediate responses like there are today. So I think it's almost impossible to say where will we be on May 15th in terms of the difference in credit requirements. I'm hopeful that, if we've opened things back up and people feel that it's safe, we'll be able to hopefully start doing interior appraisals again. And if we can, hopefully what that will mean is some of the small limitations that we mentioned about 80% versus 90% or 2-family homes, hopefully those limitations will be lifted, right? Otherwise, what I would be very cognizant of is, one, is someone still working, right? The fact is we are a cash flow lender, and if they're not employed and they can't support the debt service on the loan, that could create a problem for us in our ability to finance. Now, clearly, we'll be as diligent and as thoughtful as we can and look for alternative sources of income, et cetera, whether that's yield on assets, trust distributions, things of that nature. We do need cash flow. The second thing I think that we're going to be very cognizant of and look at is, what do asset balances look like today for someone, right? So if we've issued a commitment letter out to someone today on a purchase transaction and we validated their assets today and those asset documents don't expire for another 90 days or so. So the shelf life of most all of our documents is 120 days. Right. During this pandemic, we're going to make some accommodations and extend up to 180 as needed. Even with some appraisals, candidly, to back up that we had completed in the last year on a refinance. If a client's calling back to refinance again, we typically were able to use that same appraisal for up to 12 months. We've extended that to 24 months.
Oh, right? Wow. All right. 24.
So we're doing our best to create as many efficiencies as possible. But if a commitment letter is outstanding and the asset documents have not expired, we are not asking that client to update those asset documents prior to closing today, even with the substantial deterioration in market value. That said, if you applied to us in January, and we reviewed those asset statements and there was $1 million in an account and those asset statements are set to expire, right? We will definitely require an updated asset statement. And, if someone had left all of their funds in the market, they may be down from $1 million to $650,000. So that, I think, could impact transactions and how buyers are, whether they're able to continue to qualify or not.
Okay. Let's talk about, this might be a time, as crazy as it sounds, at least for lenders, maybe for borrowers, to say, hey, I know that I'm going to earn money at the level I was earning money once this recovery happens. And whether it's a U or an L or a V, or in my prediction, that of a bungee cord, straight down and straight up as aggressively. Interest-only loans, maybe that's the way to go for me, because I minimize my payment today, knowing that I'm gonna be making money again soon. And is there, they seem to have been discontinued for a little while after the last recession. Is that something that Wells Fargo would still look favorably on? Would you consider a borrower who's requesting that type of product?
So interest-only loans are definitely a part of our product offering. And candidly, with affluent buyers like we have in our sub-market here in Manhattan, it's a very common loan product, especially when there's large variable components of income, large equity down payments and significant cash reserves. Buyers love to have that low monthly debt service payment and then the ability to make large infusions with great bonuses, private equity distributions, whatever it is.
Exactly.
To your point, though, after the credit crisis, interest-only loans per Dodd-Frank regulatory reform were no longer fit in the definition of what is called QRM, a qualified residential mortgage. And so that is why Fannie Mae and Freddie Mac, candidly, do not offer interest-only loans.
Okay.
So it is really a portfolio or jumbo or balance sheet loan product specifically. And what I would say is that I don't see us exiting that space.
Okay.
Though the way we do underwrite those loans currently is much more conservative than we would underwrite a loan that has 30-year amortization.
Okay.
The real differentiator is that when we underwrite a loan, whether it's a 30-year fixed rate mortgage or an ARM loan that amortizes over 30 years, we're qualifying off of that 30-year payment. When we qualify off of, and in most instances, we're asking for 12 months worth of total payments in reserve. We want to be able to identify that you have that in reserve. In some instances, it's 24 months, depending on loan size, or 36 months. But in general, it's 12 months. On an interest-only loan, that interest-only payment feature is for the first 10 years. At the end of that 10-year period, the loan will amortize principal and interest payments over the remaining term of the loan, or the remaining 20 years. So the payment will jump up substantially.
Right.
When we qualify someone for an interest-only loan, we're qualifying them on that 20-year payment, right? And we're also requiring that they have 36 months worth of reserves based on that higher qualifying payment, right?
Okay.
Versus 12 months on the 30-year payment. Now, that hasn't changed in today's pandemic environment. That has always been the policy.
The higher threshold.
Yes, not always, but for the last 7 or 8 years, again, because those loans don't meet the government's definition of a qualified residential mortgage. And we as a lender need to make very sure that we're not being predatory in our lending practice, because there were so many buyers during that, last run, candidly, before the downfall, who took interest-only loans, took them at 100% financing, and now property values declined, and they had negative equity, and it just was not good business.
Yeah, and I think for the local market, a lot of the labor, a lot of the job market fits that profile that would be appropriate and match well, I guess, or match, appropriately with the interest-only structure. And I guess it brings up the question too, and this is a forecast question to a degree, Stephen, so we're not going to hold you to it, although we are recording this, so we can go back and look at the tape. Does it make sense for borrowers when they come back in the spring or May or June, whenever it is, to look into, really short-term adjustable rate products? Do you expect to see a surge in popularity for a 3-1 arm, if you even offer it, 5-7 ones, where people feel that, same thing applies. I'm going to be earning money again, and it's not likely that rates are going to get away from me, so I'll take the lower payments today. You expect to see a lot of demand for that product?
I would probably not encourage someone to take a shorter term product, in today's environment. I think for a few reasons. One, the yield curve is pretty flat at the moment.
Okay.
So a 3 or a 5-year ARM interest rate is actually not much lower than, let's say, a 7-year ARM.
Okay.
Like today, if I were to quote you a 5-year ARM versus a 7-year ARM, the rate benefit may be 0.1%. It may actually be at par the same. Then the premium to go from, let's say, a 7-year ARM to a 10-year ARM is only about 1/4 point. And then from 10 to 30-year fixed, somewhere between 3/8 and 0.5%. So the incremental premium for a much longer term product is minimal. So in my opinion, if you could buy something, that one has already been discounted in terms of the value of the home, right? But in terms of interest rates, on purchase money transactions, by the way, our interest rates are very, very, very low. So as I mentioned, that we're dedicated to the purchase market in terms of our credit appetite, and the lane that we keep those borrowers in from a processing standpoint. The interest rates that we offer on purchase transactions are about 0.5% lower than our refinance transactions.
0.5%, okay.
And so I think the fact that you're already purchasing at a discounted purchase price, your interest rate has been severely discounted. To me, now's a great time to lock something in on a 10-year ARM or a 30-year fixed. And candidly, we offer that interest-only feature on both the 10-1 ARM, and we're one of the few lenders that actually offer it on a 30-year fixed mortgage as well, which has become much more in vogue of a product.
What mortgage data can real estate brokers track right now to support, some more of this forecasting, deal volume forecasting? What does a lender, someone in your position, look at to prepare for what's coming? Can you talk about 2020 pre-approvals, requests for pre-approvals, or even applications, say in the first 2 months versus that same period in 18 and 19? And then compare it to, what happened in March in terms of data, whether it be applications or pre-approvals or general call volume. I mean, what things are you seeing, and what changes have you seen, both year over year and, month to month in 2020?
Sure. I think for us, the best thing that we can do is track really pre-approvals and purchase applications, right? That's going to give us our kind of trend line to see where things are headed. rounding the corner of 19 into 2020, I have to say we anticipated an extremely robust spring selling season compared to the previous 6 months, with so much downward pressure on our market with real estate tax reform in general from the previous year. I mean, our application volume and pre-approval volume had increased substantially. What I thought was an interesting metric, though, I did, at the end of March, I ran the analytics to see, what was our purchase application volume March 2020 versus March 2019. And I was actually pleasantly surprised that the decline was 63% from the previous year. And what surprised me about that was I would have expected in the month of March that decline would have been 90+%.
Right. I was going to say 85 or 90. Right.
Right. 85, 90%.
World came to a standstill.
Right. So to know that 37%, or call it 3 to 4 out of every 10 purchase transactions actually moved forward in the month of March, to me was a wonderful but surprising data point. So I would say pre-approval volume, purchase application volume, something that we're tracking very closely. And candidly, my team, I just know I still originate. So while I manage a team, I love what I do and I love being, in the weeds per se of originating transactions. But I've encouraged my team to continue to reach out to the borrowers that we have, in the pre-approval stage. Many of them at the moment are overwhelmed, but many are actually, quite candidly, while they're still emotionally overwhelmed and nervous, they're at home watching Netflix because they just happen to have, the time on their hands to either send documentation. They are looking for maybe a better opportunity to, maybe put an offer in that they had made a month ago that, wasn't accepted. So I think we are encouraging that. One other thing I would say, one data point that I love, one of my favorite things to read on Monday morning is the Lascher report.
Right. And I think just about everybody reads that. But that's also, that's a little bit of a lagging indicator because those deals were negotiated, a little bit earlier, sometimes weeks or occasionally even months earlier. And then you have some, maybe some, in this case, some late stage discounting to get a signature on some docs.
And by the way, I agree with that, but it actually is a public metric of, you're totally right. You're 100% accurate. I agree with you, but it actually is contracts, not closed transactions, right? So to your point, yes, they were probably negotiated a month ago, but the fact that they got into contract just, it lets us see, like I think last week there were 2 that went into contract over 4 million, right? Because the report is specific to 4 million plus. But anyway, sorry, go on.
I don't know what's happening where you are, but I'm in the throes of like a Cat 7 hurricane. So between the pandemic, the locusts in Ethiopia and Egypt, and the pandemic, I could probably sit down and write the 5th chapter of the Bible here. It's pretty wild right now. I think that building's going to blow down. In any case, how about East End activity? People made a rush for these second homes. Did you see, typically we would expect a major drop off in the second home market. Is that what happened? Were we right to infer that's what happened in terms of applications for loans out east?
It's interesting. I know you tried to protect my whereabouts, but I happen to be in Southampton right now, candidly.
Okay. At the firehouse? It looks like you're at the firehouse, broadcasting from the Southampton Volunteer FD.
The benefits of the library in my rental here in Southampton. It's interesting. I think there was definitely a flood of people that exited to the Hamptons, to the dismay, candidly, of some of the locals, I think, just from a safety perspective, which I can appreciate. I don't have that data in terms of application data. My gut is, though, when we look at this long term and we look at different areas of the economy and where they will rebound, I actually think that, people have gotten more. I think there will be robust activity in areas like the Hamptons. I think that right now it calls for people to say, you know what, I may really want or need a retreat for my family.
Right.
And so, maybe now is the time for me to buy something in the Hamptons. Listen, I think that we don't know what the ripple effect of this will truly be.
Right.
Though my gut is that there will be a much more severe impact on the middle class of America, which has a true impact, than on the uber wealthy, right? Who right now are likely very liquid and will be able to weather through some of these storms better than others and be in a position to purchase, or whether that's that the people are just buying larger apartments in Manhattan because money is cheap. Property values have come down, and because they want to start working from home because they've realized that it's truly an option. I'm more concerned about the New York City office market, quite candidly, and retail than I am about residential real estate. I could be completely wrong, but that's my hunch.
Yeah, I've been practicing that for 40-something years. I'm actually getting good at it, the being wrong game, so I can empathize, certainly. So I'm going to ask you two more things I want to touch on. And
Sure.
again, I had the benefit, certainly, of speaking with you at length this week. And you mentioned it a couple of times on this webinar, the refi market. It's a 0.5 percentage point spread, I think you said, versus the purchase money market in terms of interest rates. You want to keep, I think you referred to it as a swim lane open for the new purchases and loans to people who are going to buy. What's the bank seeing in terms of people applying for these home equities and the lines and these cash out refis, as they call them? What's the bank's stance on that? And why not be more aggressive if you can, as a bank, generate 50 additional basis points on a loan?
Yeah. So I think that what I would say is that we are open for business when it comes to refinance transactions, but in a much more limited way than purchase. So on the agency loans, Fannie and Freddie, they've dictated to the market that they will accept exterior appraisals like we've discussed,
right?
But that they will only do those refinances on loans that they currently own. So what we're doing is if a client calls us with a refinance of a transaction that falls below those Fannie Mae loan limits, we are actually going onto Fannie Mae's system to see if they currently own the loan. And if they do, we will refinance, they will allow it to be refinanced. If they don't own it, there's not an appetite for even Fannie or Freddie at the moment to refinance those loans. There is the same thing for cash out refinances. So I think both Fannie Mae, Freddie Mac, along with candidly Wells Fargo on the balance sheet side of the house, on any of these properties where we're doing an exterior appraisal, we are not allowing for cash out refinance. We are allowing for home equity lines of credit, candidly, limited up to $250,000. So there is some way to potentially access the equity.
Okay.
We haven't really worked through that exactly, but I think the real logic behind not wanting to offer cash out transactions is a real concern from both Fannie, Freddie, as well as Wells Fargo, that consumers are really putting themselves at risk if they're pulling a substantial amount of equity out of their home and then going and investing it in the markets today where they see an opportunity. If they're not a sophisticated investor, if the markets do, decline again another 30%, there's a real concern that people could really have wiped out essentially all of the equity in their home and their life savings by going and investing that capital into the markets, and why cash out is a concern. On the balance sheet side, in terms of refinance for us, one of the other limitations, really cash out is the biggest thing for both agency and balance sheet. For us on balance sheet, we have limited our refinances at the moment to borrowers who have a $250,000 deposit relationship or more with us.
Okay.
To refinance those portfolio loans. Now, this is temporary, right? We will open up that capacity at some point. And again, this is not a requirement for purchase transactions. You do not need a deposit relationship with us to make an application with as a purchase transaction. And in fact, if you have $250,000, $500,000, $750,000, or $1 million in deposit with us, there are significant rate discounts on top of the purchase
Okay.
discounts, to the point where, we're quoting 2.75% on a 30-year fixed purchase transaction, or
If you have
two,
deposits at the bank.
if you had to call it a 30% down payment on a purchase with a 780 plus credit score today and $1 million with Wells Fargo, our 30-year fixed rate would be 2.75. Our 10-year arm would be about 2.25, and our 7-year arm would be about 2%.
2%.
Now, yes. Now, in comparison, on a refinance, that 2.75 would be 3.25, right, on a 30-year fix, simply because
Right.
it's a refinance. If you didn't have a deposit relationship of any kind with us, that rate would be 3.75, right? So, you're looking at a swing between 2.75 and 3.75%, depending on purchase versus refi versus if you have a
Right.
deposit relationship with us.
Substantial.
The only thing I'd want to drive home is we are 100% open for business on purchase, and we are on refinance. We are open for business, but on balance sheet, we do require that you have a $250,000 deposit relationship with us for the time being.
For the time being, right? Okay. So let's. I'm going to give you one more thing to discuss with us, or to share your thoughts on, and then I'll open it up. Maybe we have a few questions, and if not, if there's anything that you want to share other than the idea that Wells is active and ready for the calls and ready to serve. Let's talk comparisons. Everybody loves comparisons. You've been to our office. 1918 Spanish flu. We have agents who were sophomores in high school then. And then 01, we had the situation. 08, we had the recession. How is this comparable from a mortgage standpoint? Very specifically in the mortgage market, to any one of those periods. And quite honestly, without doing the research, it's doubtful that people were borrowing money to buy homes in 2020. The home mortgage market probably didn't exist till much later than that. So really, we're talking about 01 versus 08 versus today. What are the differences that you see from the lender's seat?
Interesting. This is an unprecedented time. We've never seen anything like this. But I think the main differentiator, and it's almost a complete inverse of what we saw in 2008, 2009, is that right now banks are very well capitalized, right? We have capital. We have hundreds of billions of dollars, and a desire to lend at the moment. I think the real differentiator in 2008, 2009 was that there was this liquidity crisis, that banks had really overexposed themselves to credit risk and didn't actually have the cash needed to meet the obligations that we had made in the markets. And so it's interesting. It's a complete inverse. Right now, there's tons of liquidity. Banks want to lend, are there to help support the markets, where before, so I think the banks are going to be here to help and almost be the saving grace, or part of the saving grace, where 10 years ago, candidly, we were the problem, right? We were illiquid and we couldn't provide liquidity to the markets, which was a huge concern. And so that is why the federal government 10 years ago had to step in and provide all of these TARP loans to the banks, because we didn't have the capital we needed to keep the banking system flowing.
Right.
So now we have the capital, and the federal government has stepped in with stimulus and agreed to purchase hundreds of billions of dollars in mortgages from Fannie and Freddie to help support the housing market. Hundreds of billions of dollars to, my understanding, I believe, on these SBA loans, and it's on my specialty area, is that the federal government's taking on about 95% of that loan risk, right? And so, that's the real differential. The markets are fluid. The problem is businesses can't operate today because they don't have consumers walking through the door so that they can pay their employees.
So to summarize it, because I think this is a critical takeaway, it's a radical difference from the environment after 08, 09, where really the engine that drives, consumer spending, but the engine that drives the economy is the ability to extend credit. We're a credit-based economy, right? We do two things really well in this country. We politicize everything and we borrow. We're great
That
at
is
those
true.
two things, right? In this case, we have banks, as you said, and if you take nothing else away from this webinar, if you're still awake and listening on to this webinar, thank you. But banks are fully capitalized, they're willing to lend, and the government is also infusing the economy with trillions of dollars in essentially in cash and supporting further lending by the banks, which all, if you ask me, really points to an aggressive recovery timeline. And I don't know if you would agree with that. I don't want to put words in your mouth, but that's my feeling on this. And what you're telling us today seems to really support that.
No, I'm hopeful that what you're saying is accurate. I agree, but I think that it's all about timing is key here, right? And so it's about getting this liquidity out into the markets as quickly as the government and banks can, because unfortunately, so many people, so many businesses can't survive 60, 90 days
Right.
without any revenue. So, but I do, so listen, there will definitely be, unfortunately, fallout in the wake and businesses that go out of business. But I am hopeful that, we will be able to get back to work, and with all this infusion of capital on the strength of the banking system today, that we will rebound.
Stephen, this has been great. I think you've given us a real comprehensive look at what's happening today, in addition to some other information about the mortgage market that we can always stand to have a refresher for. And I'll give you the floor, certainly, for any closing remarks you want to make, anything you want to discuss specifically about Wells that we didn't cover here. Please, by all means, share with us whatever it is that you have on your mind.
No, I would just say, thank you very much for, asking us to participate in this webinar and for the thoughtful questions and dialogue. I've learned a lot from, our correspondence over the last few days as well, and the insight that you've provided. And I would just say, please be safe and well, and take care of your families and your loved ones as a first priority, and know that, if there's anything that you need or that we can do to help, we're available.
Thank you, Stephen. Stephen Lascher from Wells Fargo, sales manager on the 31st floor. Their 42nd Street office has been generous, giving us over an hour today, and his expertise. Stephen, thank you. Everybody can reach you on the web. And as I said, you've been to our offices, and you've always been a terrific resource for us. So thank you. Again, thank you to Jeremy Kersner. Thank you to all the other tech people at Brown Harris Stevens and Terra Holdings, and certainly Pablo Marvel and his marketing team for producing this Masters Today series with Brown Harris Stevens, the next installment of which will be next Tuesday. So signing off, and stay dry today as well as safe. Again, thank you, Stephen Lascher, and everybody have a great afternoon.
Be well, everyone.